We talked a lot about the indicators, about the chart patterns, about the candlestick patterns, about the strategies, etc. etc. But now we need to talk about the one thing that destroys most traders than bad analysis ever will, and that is psychology. Because the truth is, most traders do not lose because they lack knowledge. They lose because they cannot control themselves under pressure. And this is important to understand early. The market is not just testing your strategy, it is testing your patience, discipline, emotions, ego, and decision making. You can give two traders the exact same strategy, same setups, same entry techniques, same market conditions, and one trader will grow the account while the other destroys it. Because trading is heavily psychological, today we are going to break down the real psychological mistakes traders make, why they happen, and how professional traders think differently. This topic is actually going to be a little bit longer than the other one because 80% is the psychology and the 20% is the strategy. If your psychology is weak and you have a ever best trading strategy, I guarantee you won't make money. Now, the first thing we need to understand is this: the market is built to trigger emotions. What are those emotions? That is fear, greed, hope, impatience, and of course, revenge trading. These emotions are normal. Every trader experiences them. The difference is whether emotions controls your decisions or whether your rules controls your decisions. Let's start with one of the biggest problem in trading, and that is fear. Fear shows up in many ways. Sometimes traders are scared to enter a valid setup because they are afraid of losing. Other times they enter a trade correctly, but what happens? They close early because they panic over self-neglect. And ironically, many traders are not actually afraid of losing money. They are afraid of being wrong. And that mindset becomes dangerous because when traders cannot accept being wrong, they start moving stop losses, holding losing trade emotionally, and refusing to exit bad positions. A professional trader understands something very important. Losses are part of the business. No strategy wins 100% of the time. Even very profitable trades take losses regularly. In trading, the goal is not to avoid losses completely. The goal is to manage losses properly. Now let's talk about greed. Greed usually appears after excitement. A trader wins a few trades, confidence becomes overconfidence, and suddenly risk management appears. They increase lot sizes emotionally, they overtrade, they chase trades after the move already happened, and eventually, one's emotional trade wipes out multiple good trades. This is why discipline matters more than confidence. Confidence without discipline becomes gambling. Another major psychological problem is FOMO, fear of missing out. This happens when traders see the market moving aggressively and feel pressure to jump in late. They think if I don't enter now, I will miss this move. But many late entries happen exactly where experienced traders are already taking profits. and this creates emotional trading instead of planned trading. A professional trader understands something beginners struggle with. Not every move is your move. The market will always create another opportunity. You do not need to chase every candle. Now let's talk about revenge trading. This is one of the fastest ways traders destroy the accounts. A trader takes a loss, becomes emotional, and immediately tries to recover the money with another trade, usually with bigger risk. And at that moment, the trader is no longer following analysis. They are trading emotions. And emotional trading almost always leads to poor decisions. One important habit professionals develop is knowing when not to trade. Sometimes the best trade is walking away from the screen. Now, here is something many people do not realize. Psychology and risk management are connected. If your risk is too large, your emotions become stronger. When traders risk too much money on one trade, they start watching every candle emotionally. They panic during normal pullbacks. They close trade early. They hesitate. They overreact. But when risk is controlled properly, decision making becomes calmer and more logical. This is why professionals focus heavily on position sizing and consistency. They are not trying to get rich from one trade or overnight. They are thinking long term. Now let's talk about discipline. Discipline in trading means following your plan even when emotions disagree. That means taking valid setups consistently, respecting stop losses, not over trading or not overreacting or not becomes overconfident, and staying patient during slow market conditions. And honestly, discipline is boring, but profitable trading is usually more boring. Social media makes trading look very exciting and super fast, but professional trading is often repetitive, patient, and controlled. One thing that helps trader improve psychological is journaling. After every trade, write down why you entered, why you excited, how you felt emotionally, and whether you followed your rules. Over time, patterns start appearing. You begin noticing emotional mistakes you didn't even realize you were making. And that self awareness is powerful. Now, here is the mindset shift that can completely change your trading. Stop focusing only on money, focus on execution. Did you follow your plan? Did you manage risk correctly and completely? Did you stay disciplined? Because good execution over many trades usually creates good results naturally. But emotional trading creates inconsistency. And finally, understand this clearly. The market does not owe anyone money. It does not care about your emotions, your bills, your expectations, or how badly you want to trade. That's why emotional attachment is dangerous. A professional trader thinks in probabilities, not certainty. They know some trade will lose, and they stay emotional stable anyway. So if you really want to improve in trading, don't just study charts. Study yourself, because in the end, the biggest battle in trading is usually not against the market. It is against your own emotions. And once you learn the control, that your entire approach to trading start changing. Most trading losses don't come from lack of knowledge. They come from emotional decisions made in the wrong moment, just like FOMO. Fear of missing out makes traders enter later because they are scared of missing the move. Usually that's when smart money is already taking profit. Revenge trading happens when someone loses a trade and immediately tries to recover it with a bigger risk. The emotional pressure destroys discipline very fast. Overconfidence is another dangerous one. After a few wins, traders start ignoring risk management, increasing lot sizes, and thinking they can't lose. That's usually when the market humbles them. Then there is a confirmation bias. People only focus on information that supports their trade and ignore warning signs against it and lose aversion in very common. Traders hold losing positions, hoping they recover, but close winning trades too early out of fear. A professional mindset is very simple. Follow your plan, accept losses as part of the game, manage risk properly, and review every trade honestly. Trading is not about being emotional in the moment. It's about being consistent over hundred of trades. Join our Discord community for more trading education, market discussions, and learning resources. Scan the QR code on screen to join. And one last important information. This content is provided for educational and informational purposes only and should not be considered financial investment or trading advice. Trading financial market involves significant risk and losses can exceed deposits. All trading decisions are made at your own risk. We do not guarantee profits, income, or specific results. Past performance does not guarantee future outcomes. By using this content, you acknowledge full responsibility for your own trading and financial decisions.